Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back to Upticks with Jake and Corey. Today's episode, Corey, is brought to you by Andy Spencer. I don't know if you saw this, Corey, but Andy recently got through phase 2 of the European Golf Tour Q School. Did you see that?
I did not. Thank you for sharing.
I don't think I told you. Very big news. So basically, it's my understanding that he's going to have the equivalent of the Corn Ferry Tour status in Europe. And he gets another phase. I think if he gets through the next phase, though, he might actually have what's called a DP Tour status, which is where Chase Hanna plays, which is another golfer we sponsor. So shame on us sponsoring these kids from Kansas, Corey, that take off to Europe. But Falcon Wealth Advisors logo is in Europe right now. So who knows?
Going global.
Going global, right? And so really happy for Andy. Congrats. And we hope you keep playing well. And Corey, as always, thank you for joining me. And thank you all for joining us. Our subscriber count is quickly growing. It's probably growing faster than it ever has. So thank you to everyone who is subscribing. If you would please give us a thumbs up, like or share our content. That's the best way that more people gain access to our show. And if you remember, the whole point of Upticks is to enhance financial literacy at scale. And ultimately, it's about our clients' financial plans and what's important to them. Before we go in today's headlines, Corey, do you have any fun stuff you want to share with the potential millions of viewers / listeners?
Yes, this last weekend, my brother was in town from Chicago, Jake. So Mike and I and Connor and Matthew Navickas, actually here on the team at Falcon Wealth Advisors, the four of us got out and played some pickleball, had a meal or two with the family, took my dad to dinner on last Friday night for his birthday. So lots of fun stuff. How about you?
Oh, that's nice. Yeah, I didn't ask you why Mike, your brother, was in town. So it was your dad's birthday. Well, that's awesome. Happy birthday, Mr. Bittner.
My brother's going to be in Spain also over Thanksgiving, which is when he would have came back. So this was kind of his Thanksgiving and dad's birthday trip to Kansas City.
Got it. Did you guys eat any turkey?
We did not.
Okay. Well, fair enough.
Nope.
Well, good. Well, I'm glad your brother got to see you guys, and I'm glad you got to take your dad out to dinner. That's cool. With us, the new news now with us is the house. I'm learning a lot. I've only bought one house, which is the one I'm selling. And, I'm very lucky to have Rachel, Corey, because she is sharp on the ball. And so we're really tag teaming this thing. I'm really handling the finances, and she's handling a lot of the logistics with, figuring out what are we going to paint, when are we going to move, dealing with people coming over to see our house and all those things. So it's been fun. We're real excited. Again, we're moving back over the state line. I'm going back to Missouri, where I was born. And, I figured that Kansas City, Missouri could use some more tax revenue, Corey, or at least my money. So we're going to be paying some Kansas City, Missouri tax revenue to hopefully clean up the streets of Kansas City and make it a better place to live.
All we need was the Falcons' arrival.
So anyways, all right, let's dive into it. Let's get into the headlines. I'll kick us off here. This is actually from a listener, and I'm really glad that she shared it. And to all the listeners and viewers out there, if you do run across a headline that you would like us to discuss on Upticks, please feel free to send that. You can either send that directly to our service group, service@falconwealthadvisors.com, and they can forward it to us, or directly to Luke, who is our communications manager, simply at luke@falconwealthadvisors.com, and Luke will make sure that we talk about your headline on our show. So here's a headline, Corey. $40 billion in unrealized losses hits JP Morgan Chase as Bank of America, Wells Fargo, and Citigroup face exposure to U.S. Treasuries. Now, I'm not going to talk about the individual banks. That's not the topic of this show. But one of the pieces of the article says the banking giant is now struck with roughly $40 billion in unrealized bond losses as of Q3 of this year, which is a 20% rise over the previous quarter. And again, this excerpt is taken from Barron's, and I think they do that to give some legitimacy to the article. Corey, before I hear your thoughts, my first key point I want to make is the article is talking about unrealized losses, meaning it's just on paper. Nothing's happened. And these are major banks. Again, I'm not endorsing these banks at all. I don't want to comment on that. Compliance doesn't like us talking about individual companies, and I get it because we don't want you to go make trades because of this. But in my opinion, though, these major banks historically have been fine. Again, there's no guarantee that they will. But this is the biggest red flag that I saw in this article, Corey, and then I want to hear your comments. Is this excerpt of this article was from, I guess, a website called Daily Hodl. And my opinion is you don't want to take this garbage seriously. I don't think I've ever heard of Daily Hodl. I don't think they are reputable. They probably produce a lot of content, but that doesn't necessarily mean that it's accurate. Corey, what are your thoughts?
Real quick, I went to the dailyhodl.com ahead of time, Jake, just to check it out. News and insight for the digital economy is the basis of the website there. But as far as my thoughts around this go, I think that any bank that has bought bonds in the last several years has unrealized losses. I think that if all of those bonds are not liquidated prior to maturity, it doesn't create any major issues.
Well, let's a quick time out there, because you're right. In fact, not just any bank that's bought a bond, Corey, anybody that's bought a bond.
Anybody.
Right?
Bonds I own.
Right. Over the last 5-10 years are down in value. I mean, that's not news. Go ahead.
Right. It's math, right? Interest rates have gone up. It pushes bond prices down. This to me seems like a big sensational headline. And it is, don't get me wrong, $40 billion in unrealized losses. It would be better if those unrealized losses weren't there. So I want to be clear on that. However, I do understand why that's the way that it is. And I just reading through the article and glancing at it, there's nothing actionable to take away. There's no suggestions. It's just, it felt like here's a big scary thing for you to pay attention. Boom, here's a headline, which it feels like, frankly, a lot of things are that way these days.
Yes, many of these websites, or whatever you want to call them, feed on dopamine and adrenaline and fear and greed, whatever you want to call it. So this headline was created by some master marketer or AI algorithm with the number one goal. The only goal, let's be clear, the only goal of this article, Corey, is to get you to click on the link. That's it.
Shame on me for doing that.
What's that?
I said shame on me for clicking the link in the article.
Right. You and who knows, thousands, if not millions of other people. But the only goal of this article title is to click on that link so that therefore, more than likely, Corey, you will be fed up some advertisement. And so I've said this most of my career, actually, and it still holds true today. And Corey, I want your answer to this, your honest answer. Do you watch the Weather Channel when it's 75 degrees and no wind and sunny in Kansas City? Do you go and turn on your TV to the Weather Channel?
No.
Right. However, if there was a tornado warning or gusty winds or snow coming tomorrow, let's say there's a projected snowstorm, then would you go seek out the Weather Channel?
Maybe,
right? But it's not a hard no. So my point is, you're not going to click on this article if they say $40 billion in unrealized losses, but it's okay. You're not going to click on it, right? So you just have to understand, I want clients and potential clients and humans and individuals, anyone watching the show, to understand you need to pull out the facts from what you're reading. You have to understand hyperbole when it's being fed to you. And I would challenge you to go to reputable sources. And reputable sources, believe it or not, Corey, the Weather Channel is one of the most politically neutral stations out there. I don't know if you knew that or not. A little fun fact for you. But go to places that are more reputable, like Barron's, directly, not an excerpt from Barron's, but go to Barron's, go to the Wall Street Journal, go to something that's maybe going to tell you a little bit more of the facts, not the Daily Hodl.
I would push that a bit further, Jake, and say you could even go and analyze JP Morgan Chase or Wells Fargo or Bank of America. You can go and read the transcript from their earnings calls and look at the data yourself. It's all out there.
Yeah, but here's the key, Corey. People don't want to do that. That's boring. Or they
Headlines
don't know
better.
how to do it. They don't know how to do it. So again, the good news is maybe that's job security for you and I, that
Maybe.
we're going to continue to pull clients off of this ledge and say, look, this is crap. This is garbage. I am not reading the daily hodl. I'll tell my clients that right now. I don't read the daily hodl. I look at Bloomberg. I look at the Wall Street Journal. I look at Barron's. I look at more reputable things. I lean on my investment management group. I've got 4 people now in that group to tell me what's going on. And so, again, if your advisor's not reading it, should you be? Now let's move on. We got to move on because we have the whole show on this article alone.
We could. Next article here. This is from Barron's, Jake, one of the sources that you just mentioned. Treasury raises interest rates on I bonds purchased in the next 6 months. So this is about I bonds for our audience who's watching and listening. These were all of the rage in 2022. We talked about it here on the show, had a lot of conversations with people about it, but the whole concept of the I bond is the interest rate it pays is tied to CPI or inflation, the way that the Bureau of Labor Statistics measures that. And the point here is that from May through October of 2022, because inflation was running hotter, I bonds paid 9.6%, but it resets every 6 months. The big takeaway and the point here is that we have seen that interest rate those bonds pay fluctuate a lot. It's currently now slightly over 5% over the next 6 months. But what I found interesting about this is that the demand for I bonds has waned a lot because 1, the rates have fallen along with CPI inflation, and 2, short-term interest rates have continued to move higher. So I am curious, Jake, do you have any thoughts about I bonds?
Yeah, I didn't notice this. So they were at 4%, right? 4.3, and now they're going to 5. So I think there's 2 components to an I bond. There's the variable component and the fixed. So what this is telling me is maybe the fixed component's higher or whatever. It doesn't really matter. They're paying 5.3. I loved I bonds in 2022. Now I am indifferent because you can get around 5% in a treasury bond. Now the difference is an I bond you have to hold for a year. If you sell it within 5 years, you have to forfeit 3 months of interest. It is more complicated. You have to go do it yourself. Your financial advisor can't do it for you. And so I don't think I bonds are as big of a deal. If you are do-it-yourselfer and you have some cash, not making you 5%, I don't think it's necessarily a bad idea. Again, it's not advice. I'd want to look at your whole plan first. So I'm not opposed to them, Corey, but I think it's very important that individuals pay attention to that 6-month floating rate because they may drop to 3% or 2%. And then it makes sense to maybe start getting out of them a little bit. So I think it's good that the rate went up. I don't really understand that because I thought it was tied to the rate of inflation. Yeah, but maybe inflation's bounced up a little bit. I don't know. So correct. I know it changes all the time in CPI and PPI and all the indicators you can look at.
Pick your poison.
There's a lot of different ways to look at inflation. I know it has dropped in the last year and a half, which is good. So I'm okay with it, Corey. I don't think there's such a bad thing still. But again, just you have to be vigilant. It's something you have to manage, and you can't just kind of set it and forget it. You've got to monitor it, manage it, and keep track of it. I'm glad you shared
There it is. That's what I was looking for you. That's what I was looking for, Jake, when I brought this up, was exactly like you just said. You can't just set it and forget it, because I think this just points to that interest rate does change. There's a lot of investments that are that way, where, things ebb and flow and change, and, buy and hold. Sometimes it might work, but sometimes it might not work. And with I bonds, for example, it's important to understand what you own, and it's important to understand the right time to own it.
Right. Good. All right. Here's the next one. How to know when it's time to retire. This article goes on to say that Americans are working later than ever. The average retirement age was 62 in 2023, up from 57 in 1991, according to a Gallup poll. Pretty interesting, Corey, that people are actually working longer. And so the key takeaways, though, for this, how do you know when it's time, is number one, are you ready to or understand your identity? So redefine your identity. Creating your own next chapter. We've talked about this a lot on this show. What are you going to do a Tuesday at 10 o'clock? And then picture your legacy. Like, let's start working in the next 20 or 30 years, maybe not at your corporate job, but maybe now it's volunteering or coaching grandkids or traveling the world or writing a book. So what is your legacy going to really be? I think once you have some sort of idea, I don't expect anyone to have all of it figured out, but some sort of idea of what is your new purpose or identity going to be, because you're not the corporate employee anymore. What's your next chapter going to look like? And picture what is your legacy ultimately going to be? Then perhaps, as long as you, of course, you can afford it, then maybe it's time to retire. But what do you think, Corey, about people working longer? Does that surprise you?
No.
It doesn't? Why?
Because people are living longer and because things are more expensive.
And I also think, and I could be wrong, but I think it's because more industrial jobs have been automated. So I think the average worker in America has a more healthy, I guess, job where it's not as dangerous and not as taxing on your body. And a lot of, especially our clients that are older in their careers, a lot of them are working from home now. So why wouldn't you work 3 or 4 more years if you can work 20, 30 hours a week and get your work done and still get paid your full-time salary? So I think that has to do with the shift a little bit as well. I think, in the 70s, 80s, and 90s, I think there was more strenuous labor jobs, just more people had. And now I think machinery's taken that over and more people can work from home. And I think they're working longer because of that. So
makes sense.
Yeah. Good. What's next?
Next is an interview with Charlie Munger and Berkshire Hathaway from the Wall Street Journal. So this was published a week or two ago, right around when Berkshire Hathaway was reporting their earnings. And so Charlie Munger is 99 years old now. And in the interview, they sat down and talked with him for 2 hours. And really, I just wanted to share kind of what I pulled from this, Jake. One item of note that was really interesting is he was asked some questions about how him and Warren Buffett got their start and how they've sort of, built the empire with Berkshire that they have. And he talked about how they would find undervalued assets to buy and turn around and sell them in the future at a profit. But I thought it was interesting that he said in the world today that venture capital has made deal making far more difficult because they will bid prices up for assets much higher than they ever should. And the more expensive of a price you pay for something, the lower the expected results are, which I think was interesting, but obviously a lot changes over, 50 years. He also pointed out that capitalism should expect a few big winners in terms of companies in our country, companies in our lives. And that doesn't mean that it's time for the government to start breaking companies up because there's companies that have been successful. I liked that he pointed out that he does not know how to get smart without reading a lot. And he's done that his entire life. And lastly, he said, the biggest cognitive bias that people have, in his words, were that don't overrate your own intelligence and skills in deciding what to do and what not to do.
That's some wisdom there, Corey. Thank you for
99
sharing.
years.
99 years. He is Warren Buffett's right-hand man. Those guys are smart, clearly. What's also important about Warren Buffett and Charlie Munger, Corey, is that not all of their investments have made money. I think clients will look in their statements and wonder why all their stocks aren't up. And it's like, look, we're diversified and we're going to buy some stocks that do well and some stocks that do poorly. And we're going to learn and we're going to try to do better the next time. But even these guys in their 90s, they don't get it all right. I love the reading part. I agree with that 100%. My wife is brilliant and she reads all the darn time. So good. I'm glad you shared this one. And that's some pretty good wisdom he shared. He's usually pretty blunt with how he talks. I don't blame him.
You'll appreciate this then. One other quick point that I didn't mention in talking about this article. He talked, the question to him was, do you worry that because of your success and Warren Buffett's success in picking stocks, that it's contributed to the rise of the stock picking profession, which I thought was interesting. And he says he worries about that because he says that a lot of people have no business trying to buy their own stocks. But I think it's interesting that that's how they've accumulated their wealth, but that's not what he thinks most people should do.
Do you think that's hypocritical?
Yes,
I do. And I love these guys. Again, they're great. They're great investors. But how can you sit there and claim that you are that superior? Because I still don't think they are, right? I think they're smart guys, but they're not the only people that have made money in the stock market. And so I think I agree with you. They always pound the table and say that individuals should buy products. Now, I think though, an individual doing it on their own that gets emotional and doesn't read about investing and isn't educated about it, I could kind of see their argument there. but I think they think no one should buy stocks. And I'm like,
except for them.
right.
Yeah,
Silly.
yeah, it is. But I at least appreciate the bluntness and the transparency there. And he also said, Bitcoin was something that he was asked about, and he said it's something that concerns him because he doesn't understand the point.
Yeah. Yeah, and again,
Anyway.
he could be right or wrong about that. And I think he has a responsibility, though. You got to think about his words, ripple a lot of water. So it's probably better than him saying, you should go buy stocks, So I get it.
Sure, load up on Bitcoin. Yeah, you're
yeah,
right.
you know what I mean? So he's being
Yes.
responsible, which is good. It's not a bad thing. But I don't necessarily agree that everybody needs to buy products.
Yeah.
And maybe he's not saying that. I don't know. So, but I know they don't think individuals should buy stocks. But we're not individuals. We're wealth advisors.
That's right.
All right, good. This was kind of leading up to, you made a point here earlier today on the show. My next headline, your set it and forget it 401k made you rich, no more. This is from the Wall Street Journal. And this article, Corey, the key takeaway is that you want to diversify into more than the S&P 500 and rebalance regularly. Also know what type of bonds you own, because again, the bond market's gotten a lot trickier, as we talked about to kick off today's show. The reason I wanted to point this out is that some people think by owning the S&P 500 that they are diversified, and it's become apparent that you're not. The Magnificent Seven are really charging the returns of the S&P 500. So even though you technically have exposure to 500 stocks, you're really not getting representation there like you would if you bought small cap stocks or international stocks or real estate or gold and all these other things. So the key here, diversify, monitor your account, rebalance it, and then be careful on the bonds because the bond market has been shook. And so you got to understand, and again, it all pays to work with a competent wealth advisor. One quick plug for us, Corey, we do have technology now that actually allows us to go in there and directly manage your 401k for you so that you don't have to worry about it. You would pay us separately for that, but we can actually link in electronically, rebalance, make sure you're diversified, track your investments, monitor them for you so that you can continue to do the things you enjoy, which is hopefully working or being with your family and friends. So it's a good one. I thought it was a good article.
That is good. Yeah, that is one that you beat me to, Jake. I was going to upload that into this document for us to talk about. And when I got there, you already did it.
I beat you to it. All right, good. We got time just for a few more quick ones here, Corey. Go ahead.
All right. I'm throwing this one out. This has been reported a lot. This specifically is from the Wall Street Journal. A jury finds realtors conspired to keep commissions high. We've had some conversations on this show about homeownership and buying and selling homes, Jake, and I'm sure as a lot of people know, the National Association of Realtors and other franchisors are grappling with the fallout of a multi-billion-dollar verdict handed down last week over agent commissions in Missouri. Right in Missouri, Jake. That's where you're buying a house, where I live also. A jury concluded that the traditional practice where home sellers pay both buyer and seller broker commissions is anti-competitive and artificially inflates home costs. One point that I just want to add here is that presently, this is only a state court ruling in the state of Missouri. It, in all likelihood, will be appealed. I'm sure it's something that will continue, but I just wanted to bring this up and talk about it briefly here, Jake, and see if you had any thoughts on it, given the conversations that we've had around real estate.
Yeah, and to be fair, personally speaking, I think my real estate agent did a great job, and she's a friend, and I appreciate her. And I've got clients that are real estate agents.
Sure,
Corey.
so do I.
I'm sure you do too, right? And so I don't want to badmouth the industry. I do find it strange that the seller, pays both sides of the transaction. Like that I don't really think that makes sense to me. So I think there needs to be some reform there. Also, I had a shady situation, which I think I talked about on this show, on how, we only got a chance to put in one bid and the agent took the other offer, but I was willing to keep bidding. And there could be a conspiracy where maybe he sold that house to one of his other clients, so he got all of the commission instead of splitting with my realtor. Now, we don't know, and I don't want to make false claims, but I think that stuff kind of happens. And so I think there needs to be reform. I think real estate agents work very hard. I have a client that's a real estate agent, Corey. I think before she sold her first home, it was something crazy. Did I tell you this? I think she showed like 80 homes or 40. I mean, it was a large number. She showed this person a ton of homes. And so do I think she earned a commission then? Absolutely. So, but it's not always the case. So I think, again, I think it needs to be some reform. Like as the buyer, I wouldn't have minded paying my realtor a commission, if I understood what the value add is and exactly what she was going to do. But because I'm the buyer, the seller pays it all. So it doesn't even really matter to me, which is weird. I don't know. What are your thoughts real quick before we move on?
I think the people involved can and should be compensated appropriately. I think the lack of transparency is probably what has created the conflict in the first place.
Right.
Because there's a lot of smoke and mirrors involved in the housing market. And I don't mean that, I went through it, you're going through it, Jake. It's just, it's an important foundational bedrock of our economy in the United States. And it seems like for that reason, it ought to be more transparent than it is.
I agree. It can be simplified. It can be transparent. But a lot of it can be done online. I'm not saying to run the real estate agents out of business. I don't.
Right.
I want my clients to do well and continue to do well. I just think you're right. It needs to be changed. It's okay. It's okay to change.
And I think there's a lot of opportunity here for realtors that get out ahead of this and are transparent with people and explain, what buyer's agreements and everything else look like and what's involved. I think it's a great opportunity to get ahead of the trend.
I agree. So we'll see what happens. It'll be interesting to watch right here in Kansas City. All right, Corey, want to stick to a budget? Grab a pencil. This article was about people that keep and don't keep budgets. And the takeaways for me were most people, and this is weird, I want to know if you do this, but most people use their bank statements to budget, which in my opinion isn't what a budget really is. Right? You can't just look at your bank statement and say, okay, that's my budget, because it's too late.
No, that tells you where you spent your money. It doesn't
Right.
tell you how much you meant to spend in each place.
Right. And a quick side note, that's like saying when you file your taxes, you're doing tax planning. You're not. It's too late. It's already happened.
Exactly.
Right.
Good.
In my opinion, if you build it yourself, it will be a much bigger impact to your behavior. Many people don't know how to use spreadsheets online. So you can go with a template online, or you can literally use a pencil and paper. So that's what the gist of this article, Corey, is that using your statements really doesn't, it just tells you what happened. But if you want to plan and build out a budget, you literally can take a pencil and paper and say, these are my expected bills. This is my mortgage, my electric bill, travel, blah, blah, blah. And you can total it all up and then know where you're supposed to fall. Or if you are little tech savvy, you can go, use a spreadsheet, or there's templates out there that they're already built where you can just kind of plug in your numbers and it'll budget it. Now, I've said this before, and I want to just make a quick point here, that I really only think budgets are necessary if spending is causing you anxiety, or if your financial plan is failing, meaning you're going to run out of money. And we can see that at Falcon Wealth Advisors. So if your plan is decreasing in value and you're going to run out of money, then I think it pays to start tracking your spending and projecting your spending via a budget. So but looking at your statements, it doesn't help. It's too late. So you either need to create one online or however you want to do it, or pencil and paper. And that's the best way to do it. But only if it's causing you anxiety or your financial plan doesn't look very healthy, then I would encourage you to look at it.
Good. Get out the pen and paper. I like it. It works. It does.
Does work. Good. Corey, take us home here. We got time for one more quick one.
Last one here. You're going to like it because I've got a few charts for you here, Jake. But this was a report published
You
by...
always save the charts till the end. Why don't you bring the charts at the beginning next week?
All right. Next week.
Painful.
Next week. Everybody here watching and listening knows next week we'll throw them at the end. But this...
No, I want them in the beginning. I don't want them at
That's what I meant. That's what I meant.
Let's hear what
I said end and I meant beginning.
Here we go. Let's hear
this is how we know we're at the end. The S&P 500 has not declined in a presidential re-election year since 1952. Since 1952, the S&P 500 has not declined in a year in which an incumbent president was running for re-election. Stocks have declined in presidential election years, but in each of those cases, it was a year in which there was an open election with no incumbent running, 1960, 2000, 2008, which makes sense because presidents want to be reelected and will use the policy levers that they can and that they have available to them to help boost the economy. And in fact, every president who avoided a recession 2 years before their reelection went on to win election again, which I just think is really interesting. And the chart that you're looking at on the screen is highlighting what the returns in those election years have been and has shown that the 3 down years have all been open elections. What do you make from that, Jake? Give me your opinion. You've got to have one.
Coincidence. I think these charts are hogwash. I think it's coincidence. So did we have a recession under Biden's administration?
I think that probably depends who you ask.
And you said it's 2 years prior?
Yes.
So I think we did have a recession within the last 2 years. Didn't we technically have 2 consecutive quarters of negative GDP within the last 2 years? Do you know that?
Yes, we did.
Okay.
But we did not call it a recession. The National Bureau of Economic Research did not call it a recession.
Right, even though it technically is one. Now, again, I'm not saying I like Trump or Biden. I'm just saying you can't change the definition of something anyways, and then use the data. So it is interesting. I'm glad you shared these charts. What's the second chart real quick? So we got the first one was the 3 down years were only in open election years. What's the second chart telling me?
The second one here has shown that stocks have performed better in presidential re-election years versus open presidential election years, which is aligned with what we just talked about, but you can see it. And then at the bottom, it really just drives the point home. The last chart, election years where the incumbent party loses have been the years where there's higher volatility and lower returns. But what really stuck out to me, Jake, in looking at this last chart is that regardless of the volatility during those years, the results a year later were very, very similar.
That tells me to me, this says it doesn't matter. I think you're right, though. I think it makes sense, like you said, the current president, whether it's Biden or Trump, will obviously want the economy and the market to be doing well before election. It makes a lot of sense.
Yes,
but doesn't that bother you? Doesn't that bother you a little bit? Like that means it's not really a free market.
Yes, it does.
That it can be manipulated and it can be influenced by politicians and policy, not by earnings. It should be earnings, right? And cash flow.
Absolutely. So, yeah, I mean, there's a reason the banks have $40 billion in unrealized losses, right? I mean, to just kind of bring it all back home here, just in terms of spending. The government has issued a lot of debt to spend money, and politicians' primary responsibility typically is to get reelected.
What do you think this has to do with the unrealized losses, though?
I think that our government has been spending more money than they have coming in for a long time, and they've issued a lot of debts at low interest rates. And now that they've raised interest rates, that's pushed the value of that debt down. But the debt wouldn't exist if they didn't have to fund their operations through issuing it.
Yeah, I guess so. I see it.
It's like back to the budget. I mean, it all ties in together. Jake, and it's different, of course, with the government. But the point is that if you were spending and your income are aligned, things work. If you're spending a lot more than your income, eventually there are bumps in the road. And that's what we've seen. We've been dealing with it.
Yeah, but does the fact that the government's spending, that doesn't have anything to do with the bonds being down in value? But you're just saying they issued a lot of debt, but those are bonds. Like the banks bought.
Sure.
Them.
Well, but the Federal Reserve bought trillions of dollars of bonds since the financial crisis, and they bought them no matter what the yields on those bonds were. And now that those bonds have gone down in value because interest rates have gone up, and they're letting a lot of those mature through quantitative tightening, which everybody's still figuring out, frankly, because that's something new from the last 15 years. The point there, though, is that I don't think it's not a surprise to me that we've seen long-term interest rates move up as the Federal Reserve has been letting assets mature off their balance sheet.
That makes sense.
That's a whole nother conversation.
What a way to end our show, Corey, with politics.
This is why we needed charts at the beginning, huh?
You had to bring politics. We already had our political episode.
We're going to get inundated over the next year with the politics stuff. And I think if nothing else, looking at this, I look at this and think, this actually helps simplify a lot of things and helps to ignore a lot of the noise.
Yeah, I still don't think it's going to predict the future. We'll see what happens.
Yes, we will.
Well, okay, good. We got to wrap up. Thank you, Corey, for your charts. Yeah. Thank you for joining me on Upticks. And thank you all for listening and tuning in. We hope you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.